Datadog completely crushed the Q2 2026 consensus. I mean, revenue reached $1.12 billion.
Yeah, that's up like 36% year over year.
Right, and non-GAAP EPS hit 65 cents, so they comfortably beat that 58-cent estimate. Management even raised the full-year revenue guidance to a range of $4.45 billion to $4.47 billion.
Which is a massive beat and raise, honestly.
Exactly. But despite all that, the stock just plunged 19% right after the report, closing at $229.29.
It's such a wild disconnect. You've got this print that looks, well, pristine on the surface, and then just a violent market rejection.
Yeah, so today we are pulling apart Datadog's Q2 earnings report, the call transcript, and those ensuing analyst notes. We need to figure out why a seemingly perfect quarter triggered such a massive sell-off.
Because, how does a company do practically everything right and still lose a fifth of its market cap in a single trading session?
It reminds me of looking at a highly tuned Formula One car. It's built for absolute speed, and it's priced like it.
Trading at roughly 100 times forward earnings, right?
Right. And when you are paying that much for perfection, even the absolute slightest unexpected rattle in the engine just makes buyers walk away. So let's look at that engine first. How strong was the actual growth?
Well, the underlying growth engine is exactly what sets those sky-high expectations. Customers generating over $100,000 in annual recurring revenue, they grew 23% to 4,720.
Wow. And looking through the segment breakdowns, it really stood out to me that this wasn't just a handful of, AI hype cycle companies driving the volume.
No, not at all. Revenue growth among their non-AI customers actually accelerated into the high 20% range.
Which is huge. Plus, something like 60% of their customer base is now utilizing 4 or more products.
Yeah, nearly 60%. It totally validates their land and expand strategy. They get their foot in the door and then deeply embed themselves into these massive enterprise architectures.
They really do. But, this is where we have to look under the hood at the actual cost of that growth.
Right, because it's not cheap.
Not at all. And I want to challenge the profitability narrative that management is pushing here. They touted a 23% non-GAAP operating margin.
Which sounds incredibly healthy on paper.
It does. But when I look at the GAAP operating income, the metric that accounts for all real expenses, it was a meager $5 million.
Yeah, it basically vanishes.
We are talking about a $1 billion revenue quarter, generating effectively a 0% GAAP margin. The gap there is entirely stock-based compensation, right?
Precisely. They recorded over $220 million in stock-based comp, and that is just in this quarter alone.
That's wild.
It is. Mechanically, you are issuing new shares to pay employees instead of using cash. So while that keeps the cash flow statement looking pristine, it silently inflates the total number of shares in existence.
Right. So if you were a retail investor buying in at a 100x multiple, you need massive bottom line growth just to tread water against that constant dilution.
Exactly. It creates a structural ceiling on the valuation.
Right. So the market is looking at a company trading at a massive premium, heavily diluting its shares to fund operations, and then management drops the hammer on the earnings call.
Yeah, this was the primary catalyst for the multiple compression. Management disclosed that their largest customer, which is widely identified by analysts as OpenAI, they renewed a massive 9-figure deal. But they committed to structurally lower usage starting in Q3.
There's the rattle in the engine.
Exactly. OpenAI is likely getting so large that running off-the-shelf observability tools at their immense compute scale is just becoming prohibitively expensive.
So they're actively restructuring their telemetry to send less data to Datadog.
Right. That exposes severe customer concentration risk. And the mechanical effect of that lower usage was instantly visible in management's Q3 revenue guide.
Yeah, they projected between $1.135 billion and $1.145 billion.
Which is basically a flat sequential line from this quarter's $1.12 billion.
Right. And when your absolute biggest client starts aggressively optimizing their software spend, it just fundamentally breaks the forward-looking math.
Absolutely. You pair a massive valuation multiple with flat sequential growth, and multiple compression is basically mathematically guaranteed.
Yeah, investors just sprinted for the exits because that growth premium evaporated the second the Q3 guide came out.
The market simply doesn't tolerate decelerating usage at these multiples.
No, it doesn't. So for you listening, the main takeaway from these earnings notes is this. Datadog's core business proves that enterprise multi-cloud and broader AI adoption are still booming.
Yeah, the underlying product demand is incredibly real.
It is. But when a stock is priced for absolute perfection, any hint of spend optimization from a mega client will trigger a violent reality check.
Which leads to a broader question you should probably be considering as you watch the SaaS sector going forward.
Oh, what's that?
Well, if the apex predators of the tech world, like these massive AI labs, are hitting a scale where they are aggressively optimizing and building their own internal tooling to cut off-the-shelf software costs, does that mean the most valuable companies in the world will eventually age out of the very SaaS products that grew up serving them?
Follow the show for daily earnings coverage.